Welcome to the Commercial Know-How podcast, where mortgage brokers learn how to successfully launch, manage and grow a commercial finance business. I'm your host, Belinda Gibson. Join me as I draw on more than 25 years of property finance expertise to show you how to diversify beyond residential and build a growing business for all seasons. Don't forget to hit subscribe and visit commercialknowhow.com.au to download my free ebook to help you get started in commercial finance. Now, sit back and enjoy the episode. Hi, and welcome back to Commercial Know-How. Today we're going to be talking about ratios and 6 of the must-know ratios when you are completing a financial assessment. So when I'm looking at small business transactions and they're under $1 million, I'd probably only really use the interest cover and the debt service ratio. But if I am looking at a more complex commercial lend, and it's a fairly large trading business looking at borrowing, $1 million and above, I'd try and use as many of these ratios as I can that are going to be applicable to their business. So when completing a financial analysis, there's several ratios that I want you to consider and whether you should for your particular client. So number 1 is the current ratio. So this ratio measures a company's ability to cover its short-term obligations. It's calculated by dividing the current assets by the current liabilities. It's really simple. And here a ratio any times greater than 1 times cover is acceptable. It just indicates that the firm has enough current assets, like cash, to meet its short-term obligations and pay their bills. So in real dollar value or real terms, a 1.5 ratio means the company has $1.50 of current assets for every $1 of current liabilities. So that's good. Anything greater than that is also good. Number 2 is the debt to equity ratio. So this indicates the proportion of debt to equity financing used by a company. It's calculated by dividing total debt by the shareholders' equity or just equity in general, always found, at the bottom of your balance sheet. So here sort of a 1 to 1 times 5 cover is acceptable. We want to see a higher ratio of equity than debt. Always. Anything less kind of tells us that the company has a reliance on debt. Now, they might not have a lot of equity if it is only a really new business, so I wouldn't use this ratio in that scenario. And don't use it if you are assessing a trust entity, because you'll recall that when you're looking at a trust profit and loss, there's really only ever a balancing $20 item there. So I wouldn't use this ratio in those scenarios either, because remembering the trust distributes the profit, so there's not going to be any equity left over there from prior years. Number 3 is that gross margin ratio. So it's also known as the gross profit margin ratio, and it's a profitability ratio. So here we want to have a look at, the revenue that a company's making, and what their actual gross profit is against their cost of goods sold. So we want to look at the gross margin ratio. So that's your total revenue, and we're going to take away the cost of goods sold. So if your business is selling an item, they're going to have a cost of goods sold expense line. So what determines a solid gross profit margin here will depend on what industry they are actually in. So some industries will have a really high gross profit margin, where others it can be really skinny. And if there are economic situations that are impacting their industry, where consider the building industry, we've had a history during COVID where the cost of goods to build a home have increased rapidly. So this would hurt a builder's gross profit margin. So rather than comparing apples and oranges and determining, what's a good profit margin for X industry, you can also compare the results for the same client against previous years. So that will tell you if their gross profit margin is steady, whether it is increasing or decreasing. If it's decreasing, it does indicate that their cost of goods sold are increasing and vice versa. So it does open up an opportunity for you to ask, what's happened to their gross profit margin. It will generally tell a story about what's happening to their business or their particular industry. Now, number 4 is the return on assets. So this ratio measures a company's profitability in relation to its total assets. So an ROA is used to determine whether a company uses its assets efficiently to generate profit or not. So again, this can determine what sort of industry they're actually in. So if they don't have a lot of reliance on their assets to generate income, it may not be relevant. So if your client is sort of an office bound, they don't have a reliance on assets and goods, I wouldn't use this. But if they, say, for example, if they are freight or, even a trucking company, I'd probably use this ratio and just compare it to prior years to see if there's a story being told here. In general, the higher the return on assets, anything really above 5%, the more effective the company is at using their assets to generate profits. And number 5 is the return on equity. So this is the measure of a company's net profit divided by its shareholders' equity. Now, this ratio, again, is a tool to evaluate investment returns of a company within a particular industry. We want to see how profitable they are and, what they're doing with their equity to generate income. So a low return on equity means that the company earns relatively little compared to its shareholders' equity. Now, you might see this in a startup business. I'd probably be concerned if you had an established business that didn't have a lot of equity or it wasn't earning enough profit in comparison to the shareholders' equity there. It may be that they've been paying out dividends in the past and their shareholders' equity is actually reducing. So you can ask additional questions about that. But again, pick your industry here and the age of your business. And number 6 is that very common one, the one we all love, interest cover ratio. This is the most common cash flow ratio to measure your client's capacity or their serviceability. So ICR is used to measure how many times a company or a business can pay the interest due on any outstanding debt. Now, the interest cover ratio is calculated by dividing a company's earnings before interest and taxes, so we call this one EBIT, by its interest expense during a given period, normally a financial year. 2 times cover and above indicates a good pass, and here all lenders' policies will differ from 1.5 times and above. Now, when we are looking at the interest expense in the profit and loss, we will get a different figure than when we're looking at capacity and serviceability. So remember, the financials are the historical measure on the actual interest expense. But when you're doing a capacity to repay or a serviceability, we want to have a look at the interest cover using the EBIT figure and the forecast interest for the new debt. So it's a little bit different, but we still want to see the same sort of results. Now, number 7 is debt to service ratio. So sometimes we save the best to last. So if your client is paying principal and interest reductions on any proposed lending, we need to consider the DSR, debt service ratio. So this shows the lender if a business or a company has enough income to pay its debt. Now, remember, we're looking at principal and interest reductions with this measure. Now, this measure is used by calculating a company's earnings before interest, taxes, depreciation and amortization, so we call this one EBITDA, by its principal and interest expenses during a given period, normally a financial year again, and anything 1 times cover and above indicates a good pass. Now again, lenders' policies will differ from 1 times cover and above. And remembering that if we are measuring the EBITDA off the profit and loss, we also need to consider the future principal and interest reductions. So if you are proposing a new commercial property, you need to bring in that new debt and the existing debt, what the repayments are, and then measure it by the historical EBITDA figures. Now, we also discuss ratios in our chapter on the 5 C's of credit. But if I'm looking at a transaction under $1 million, I would really only be measuring interest cover ratio and debt service ratio, because this is our capacity to repay the loan. Now, remember, capacity is often determined through ratios and how many times over the business can make the interest or debt commitments on the loan. Now, to assess capacity, when you're looking at your future proposal or your future commercial property purchase, you should assess with a buffer on the actual rate. So as a rule of thumb, I like to use 1.5 times above the actual rate, but you'll soon discover that each lender has their own method. So if you wanted to be conservative and you've been quoted 7% by X bank, then use a 2% buffer. Now, other ratios may also be considered to measure capacity, like the current ratio or the debt to equity ratio, as we've discussed above. But I would typically only see these in transactions above $1 million. Now, again, ratios can also be referred to as covenants in a loan contract. And this is to ensure that the business continues to meet the bank's capacity guidelines in future years, particularly if your client is subject to annual reviews of their lending. Now, again, you're only going to see covenants built into a loan contract for those higher end commercial deals, commonly $3 million and above, because banks don't want to be doing annual reviews for the purpose of doing an annual review. You really want your client to have those longer loan terms, but keep this in mind that you need to look at any covenants that do come out on those higher deals. So the ratios that we have looked at today provide a snapshot of different aspects of a company's financial performance and are useful in assessing their liquidity, their solvencies, the profitability, and the return on investment for their shareholders. However, it's also important to consider industry norms and compare ratios to peers for a more meaningful analysis. Now, information around industry norms and comparing ratios to peers is not going to be commonly available. And if you are interested in these types of access, IBIS reports can be really helpful. So that's IBIS, IBIS reports. Annual industry reports do come out, and it will sort of compare your client against industry norms across Australia. So thank you for listening to Commercial Know-How podcast today. Don't forget to visit us at commercialknowhow.com.au, where you can download my free ebook to help you get started in commercial finance and find out how to get in touch with me. Please make sure you subscribe on your favourite podcast player so that you don't miss an episode. See you soon. Thanks for listening to the Commercial Know-How podcast. Don't forget to visit commercialknowhow.com.au, where you can get in touch with me or download my free ebook to help you get started in the commercial lending space. If you enjoy the show, please hit subscribe so you don't miss an episode. See you soon.